Ladies and gentlemen, good day, and thank you all for joining us for this HCR Wealth Advisors Q3 2020 webcast. To get us started, I am pleased to turn the floor over to our host, Mr. Jordan Kahn. Welcome, Jordan.
Thank you, operator, and thank you, everybody, for tuning in today to our Q3 2020 webcast. Let's get started, starting with things that we are looking at. One of the things that we're seeing currently is a record plunge in GDP. And so if you look at this chart on the screen, you can see that this chart goes back almost since World War II. And last quarter, we saw almost a 33% plunge in GDP. So you can see never in history have we seen something like that. Now, of course, this drop in Q2 GDP will always have an asterisk put on it because it was obviously a government-induced shutdown that caused, such a large contraction. But nonetheless, we will have to, monitor the damage that's done from such a large contraction, and also, and more importantly, how long it takes for the economy to climb out of this hole that's been dug. So we had this shutdown. We're having kind of this uneven reopening of the economy. We'll have to see how quickly the economy starts to bounce back in Q3 and Q4, and just really how long it will take to kind of work our way back from this economic decline. Today, the Bank of England came out and was giving its economic assessment, and the governor said that they thought that it could take until the end of 2021 for them to get back to kind of pre-COVID economic levels. So we'll have to see if it takes the U.S. that long or if we can move at a quicker pace. Also, in addition to the plunge in GDP that we saw, we also have seen a historic spike in unemployment. So this bar on the right shows you that employment spiked up into the mid-teens, higher than at any other point in the post-war era. And again, the same kind of expectations or timeline applies here, and that is that we're going to have to watch how long it takes for employment to kind of get back to more normal levels. So tomorrow we're going to get the July jobs report. We've seen unemployment start to inch back down a little bit as the economy has been reopening. Tomorrow maybe we'll see the unemployment get down somewhere maybe around the 10 or 11% level, but really to be back to kind of quote-unquote more normalized levels, we probably need to see unemployment get back into the mid-single digits. And so it'll just be a question of how long it's going to take for that to occur. The flip side of looking at unemployment is looking at employment. And so this slide shows the historical trends in employment in the U.S. And the peak here, if you look on the screen, is in April of 2000, roughly 65% of the population was employed at the time. In subsequent recessions and recoveries, the percentage of the population that was employed has kind of trended down and made these lower highs that you see on the chart. Currently, with the recent plunge that we've seen, right now we only have less than 53% of the population employed. So that means about half the U.S. population is jobless right now, which is obviously a huge number, but will likely come down as we continue to see the economy reopen. And so the things that we'll be watching for is, are there any kind of structural or lasting effects from such a large drop in unemployment? Are there some people that just will drop out and kind of won't rejoin the workforce altogether? And how much of that will be offset by the younger people, new entrants into the workforce that are joining the workforce for the first time? How much of that will offset some of these people that have just stayed out of the workforce? The reason why these trends are so important and why we monitor employment is that employment really correlates to consumer spending. If you have a job, then you're likely to spend more money. And since 2/3 of our economy is dependent on consumer spending, these are obviously important trends for us to monitor. Another thing that we witnessed with this big drop in employment was that we saw the savings level just skyrocket here in America. Again, this long-term chart here, you can see in this blue line, this is the savings rate, and you see this parabolic move higher in the last quarter. So as people were worrying about their jobs, they were saving more money. Also, as there were more people that were at home because of the quarantine, because of the stay-at-home orders, more people at home meant that there was less spending occurring. That caused an increase in savings. And also, it's likely that a lot of people that were getting increased unemployment checks or stimulus checks, a lot of that was probably socked away into their savings as well. As financial advisors, we usually advise our clients that saving is a good thing, but it's not good when it happens all at once across the economy. So the famous economist John Maynard Keynes had come up with a theory called the paradox of thrift, and that said that while savings is good on an individual basis, when it occurs across the economy all at the same time, it's very bad for the economy, because if everybody pulls in their spendings, it can cause an outsized contraction, and that's what we've seen. One of the things that the Fed usually does in reaction to this, and not just this, there's a myriad of other factors, but what the Fed did in March was it slashed interest rates, right? So the Fed quickly cut interest rates all the way down to zero. And one of the things that does is it discourages savings. So all that money that was socked away in savings accounts and checking accounts, if the Fed cuts rates down to zero, that money isn't earning anything. And so it's kind of a disincentive to just leave that cash sitting there doing nothing. The Fed would like to encourage savers and investors to do some more productive things with that money, to move it out of cash and into other investments or into the economy. Another thing that happens when the Fed slashes interest rates is that it puts pressure on the dollar. So lower interest rates often cause a currency to go down. So you can see that as the Fed has cut interest rates, this chart here on the left shows that our dollar has gone down. And there's been a lot of talk about gold recently. Why has gold gone up? There's a number of different theories, whether it's distrust amongst the central banks or worries about inflation down the road. But in its simplest form, the dollar usually moves in opposite direction, or gold usually moves in opposite direction as the dollar. So when you have the dollar down, you have gold rising. And you can see the correlation is pretty strong. Here on the left is a chart of the dollar. So even when the dollar had this spike higher in March, you can see that gold had a corresponding move lower. And since then, since that spike as the dollar has been trending down, gold has been trending higher. So there's a basic correlation between dollar down and gold up. That's usually the easiest explanation. And this is another thing that we'll be monitoring to see how long it can continue for. Continuing with the Fed, another thing that we've seen is this historic level of liquidity that the Fed has put into the markets. So as this pandemic unfolded, the Fed acted much quicker and also much bigger than it did the last time around in the great financial crisis. This chart, you can see here, it says the Fed has brought out the bazooka. So all of these programs were basically all enacted in the first month during this pandemic back in March. That compares to 2009, when the array of programs that the Fed enacted back then really took about 12 to 18 months before they all were fully enacted and kicked in. So there was a much longer lag time the last time around. This time the Fed really moved quickly and early to try to stem the damage. And these are all the Fed programs here. That's half of the liquidity that was provided to the market, or more than half. But the other side of the equation are all of the programs that the Treasury has done. So we had the Paycheck Protection Program, increased unemployment benefits, and also the stimulus checks. And so the combination of the Fed with all of their programs and the Treasury with their programs together has created this historic liquidity for the markets. We thought this was a pretty funny cartoon. This is Bully, the bull market bull here, who was kind of looking like he might be on his last leg before he got the injection by the Treasury and the Fed of all this liquidity. So we called this juicing the markets. And what happens is when the Treasury and the Fed juice the markets, all that liquidity tends to boost financial markets. It tends to find its way into financial markets. So here you can see liquidity boosting not just stocks but also bonds as well. The chart on the left shows that since the March lows, this general uptrend that stocks have been in, and you can see a similar uptrend with a brief hiccup here, but a similar uptrend for bonds also. And if you looked at charts like copper and nickel and silver and some agricultural commodities, you tend to see it there as well. So in general, when you have excess liquidity being injected into the system, it tends to boost financial instruments. So where has all this liquidity fueled rally left stock valuations? The answer is quite stretched and elevated. This chart looks at the forward PE multiples for stocks. And the PE multiple, that is price divided by earnings. So you take a stock's price divided by its underlying earnings, and that gives you what we call the PE multiple, which is a pretty standard valuation metric used by investors. What you can see is this recent spike higher in stock prices on the S&P 500 has led to a current PE multiple of about 22 times. And that's the highest it's been since all the way back in this 99-2000 time frame, back when the market was in a bubble. So you've had earnings declining at the same time that stock prices have been going higher, and that's what's caused this large spike in PE multiples. The average here, this dotted yellow line, shows the median or the average over the last 25 years, which is about 15.5. So current multiples are well above average, all the way back to these bubble highs back in 99 and 2000. And what this likely means is that stocks have gotten ahead of themselves. And so from here, either stocks can pull back to kind of bring in valuations or bring in the PE multiples, or stocks could go through kind of a sideways consolidation period that would allow earnings to catch up, and that would serve to bring in the multiple as well. We've also seen overly bullish investor sentiment. So whether it's the Fed providing all this liquidity to the market or the Treasury with all their stimulus plans, but what it has done is emboldened investors to become more complacent about stocks, to have less fear about the risks. This chart is a chart that Citigroup has been putting out for decades, which is a proprietary model that they run that they call the Panic Euphoria Index. And it shows when investor sentiment, how it moves back and forth from these stages of panic versus euphoria. You can see that in March, it dipped down into this panic region here. Since then, it's been bouncing back, and more recently, it's moved up into euphoria. And just lately, just in the last month, it's reached even higher or reached even deeper into the euphoria levels than it did get down into the panic levels back in March. So investor sentiment also seems pretty stretched in addition to valuations. Looking at the market a little bit deeper, we take a look at leadership in the market. And so by leadership, we mean the number of stocks that are participating in the market. One of the things that's kind of unique right now is that the leadership in the market, in the S&P 500, has really started narrowing to a significant extent. So this chart looks at the 5 largest stocks in the S&P right now. And those are the FANG stocks that you hear about, right? So Facebook, Apple, Amazon, Microsoft, Google. Those are the 5 largest stocks in the market. And by market cap, right, their market capitalization measures how big a company is. So the top 5 stocks by market cap now represent 23% of the S&P 500, right, which is just a historic amount. The only thing close on this chart was back in the bubble of 2000, the top 5 market caps reached 18%. So we have surpassed those levels and reached a new record. Interestingly, the top 5 stocks back in 2000 were a much more diversified group. The top 5 back then were Microsoft, GE, Cisco, Exxon, and Walmart. Today, the top 5 are mostly tech stocks. But we monitor this narrow leadership because it's not really a healthy trend. In healthy markets, you have leadership that's much more broad. And an example would be, think about the bull market back in the periods from, let's say, 2010 to 2017. If you look down here, you can see that the top 5 stocks back then only made up maybe 11 to 12% of the market. So that's a more healthy scenario. But now we've almost doubled, and so you have these top 5 stocks just taking up a huge portion of the index. This is another chart of the same trends that we're looking at. So here you can see the top 5 the FANG stocks. And then the red line at the bottom, they call this the deadweight 495, but this is the other 495 stocks in the S&P 500. And you can see that how this divergence started in the mid-2010s, 2015s, but in recent years it's just really accelerated, and now you have this kind of historic gap or this historic discrepancy between the top 5 and the rest of the 495. So this is another, when we talk about these stark contrasts or divergences, this is another one that we're seeing that probably isn't sustainable and at some point will likely narrow. We can also look at this concentration in terms of how it's impacting returns. So this chart here shows different market caps, right? So the largest stocks versus the smaller ones within the S&P 500. And this was as of early July, but you can see the top 10 stocks in the market at the time had a return of roughly 10% versus the average stock in the S&P, which was down 11%. So basically, only the top 50 stocks had positive performance, while the bottom 450 were negative. So you have this really, really large market cap divergence where only the biggest mega cap type stocks are seeing positive returns, and the rest of the market is really struggling. We can see this in other indices as well. This top line here is representative of the NASDAQ 100, right? This is kind of a large cap tech dominated index, and you can see that that index has fared very well, up 25% on the year. The orange line is the S&P 500, which is a more broad index, and it's only up 2.5% through the end of July. Looking down further down the market cap spectrum, the next line is representative of the Russell 2000. So this is an index of more smaller cap stocks, and we see that the Russell 2000 is still down 10% on the year. And then the last index on here, the green line, this is my favorite index to monitor when I'm looking at how stocks are faring overall. And so this is the Value Line Index, and it's a group of thousands of stocks. It's not market cap weighted or price weighted. It's just an index of stocks that have large caps, mid caps, small caps. It has growth stocks and value. So when somebody says, how's the average stock doing, the Value Line is a good representative index of that. And the Value Line Index is still down 17% on the year. So depending on how an investor's portfolio has been allocated this year, if it's had a lot of large cap tech and growth, they're probably feeling good about their portfolio. And if it has had a lot of smaller cap or more value type stocks, they're probably not feeling as good. In addition to the market cap discrepancies, there's also a big gap between growth and value stocks. So what we did here was we looked at 2 ETFs. The top one is a Vanguard Pure Growth ETF, and you can see that that ETF is up over 20% on the year. And then the next ETF is a Vanguard Pure Value ETF, so an ETF that's full of value stocks. And that ETF is down 12% on the year. So you have this really wide gap between growth and value, and this is just this year, just year to date through the end of July. And this gap is 33%, so there's a 33% discrepancy between growth and value year to date. That's a historically wide gap. And again, just like the market cap gaps that we saw, it's a trend that is probably unsustainable, and at some point will likely converge or will have some sort of a reversion to the mean where the spread narrows. The last kind of divergence that we wanted to highlight was that between the NASDAQ 100 and the S&P 500. So the NASDAQ 100 is the tech-dominated index that we always refer to. You can see back in the bubble of 99 and 2000, you had this period where the NASDAQ just really outperformed the S&P 500. Then it came all the way back down. In recent years, it's kind of been trending higher, meaning the NASDAQ has been outperforming the S&P. But lately, again, we see this index really, or this ratio really turn higher and almost move parabolic. And recently, we've reached a new record level. So we're back at record levels in terms of the NASDAQ 100 outperforming the S&P. And this is really because of kind of this new bubble era that some of these stocks have entered into. So we have a lot of these discrepancies or divergences that we have highlighted today. One of them was large cap versus small cap stocks. Another one was growth stocks versus value stocks. And the last one is the NASDAQ versus the S&P. These are all historically wide divergences that we think are probably getting somewhere in the late innings, and at some point that there will probably be some reversion to the mean for these. So why are we having this kind of newfound bubble in some of these NASDAQ or technology stocks? What happens is, in 1999 we had this internet bubble, but really, to get another bubble, you have to have a whole new cohort of investors that doesn't really remember the outcomes or the aftermath of the last bubble. So you have a lot of newly minted investors that are really gung-ho on this new trend, and the new trend is of that towards a more digital economy. So kind of thinking about it as a move away from the traditional, more physical economy towards digital, or away from what they call the brick and mortar type businesses to be able to do more business online. So this chart shows several of the areas that are represented in this digital economy theme. I won't touch on all of them, but I'll give you a few examples. An example is you have digital media and entertainment. Think about stocks like Netflix, where you can watch all of your things online, don't have to go to the theaters or worry about tuning into TV. E-commerce and payment processing, these are companies like PayPal and Square that have seen tremendous growth relative to the traditional banks. Increased screen time. Stocks like Facebook and Google have obviously been big beneficiaries of that trend. Another one that isn't public yet, but that you've probably heard about in the news, has been TikTok. So TikTok is an app. If you have kids that are 10 or older, you know exactly what I'm talking about, this phenomenon of TikTok that has taken up so much of their time on their phones. And if you don't have kids that are in that age group, then you probably don't understand what all the hubbub is about. But TikTok has been a huge screen time beneficiary of all this. Cloud infrastructure, those are companies like Amazon and Microsoft, where other companies are moving a lot of their infrastructure to the cloud instead of having to host everything on-premise. And something like autonomous and electric vehicles, the poster child there, and probably one of the biggest stocks you can look at in terms of this rampant optimism, has been Tesla. So those are kind of some examples of this digital economy theme, and these are the stocks that have really been running the most this year. When we look at those stocks, a lot of these digital economy stocks, we talk about them in terms of a bubble. When you get into one of these bubbles, you have investors that are really willing to pay any price, and so they don't even mention valuations, right? It's really just about the story, how fast they're growing, what their opportunity is. And so here you can see a large array of various valuations for a lot of these stocks. And so if these were just PE multiples, they would probably look high. But these aren't PE multiples. These are actually price to sales figures. So many of these companies don't even have earnings, and they're still trading at 20, 30, 40 times sales, which is crazy. So these are unsustainable levels of valuation. Again, it's hard to say exactly what inning we're in of this current bubble scenario, but we probably are somewhere in the late innings, and again, we know that at some point that this is going to reverse, and there will be, downside as well for these stocks. So with all the different cross currents that are out there, it isn't too surprising that there's a lot of confusion. It's not just regular investors that are confused. This chart shows the standard deviation for Wall Street strategists' year-end price targets, and this is a 20-plus year chart. You can see that for this year, for their 2020 year-end targets, that there's never been a higher discrepancy or a higher spread between the various strategist forecasts. So if you're confused about things that are going on this year, you're not alone. in summary, what are we seeing? Well, we're seeing a lot of stark divergences in the stock market. We're seeing big divergences in growth stocks versus value, divergences in large cap versus small cap. We know that at some point that there will be likely some reversion to the mean in terms of kind of those trends or those gaps narrowing. We also have seen large discrepancies in terms of all of this government stimulus versus what's going on in the economy, right, or the economic gravity. So we have really high unemployment. We've had these quarantines or stay-at-home orders, uneven openings of businesses, and a lot of businesses that are still closed. And so what the market's kind of saying right now is that it feels that all of this government stimulus will be enough to kind of bridge the gap until we get to the other side, maybe, of some sort of vaccine or antiviral or something on that end. And that is our next point on here, which is this vaccine waiting game. So there's currently probably a dozen large companies that are in phase 3 trials for a vaccine. And I think the market is very hopeful that maybe within the next 6 months we will see something definitive on the vaccine or the antiviral front or both. And I think the market's hopeful that that will kind of be a game changer, that will be meaningful at that time. We will have to see if any such vaccine, how safe it is, how many people take it, and that sort of thing. But it does seem to be that that's going to be kind of the precursor before the economy can, get back to some sort of more normal-looking picture of things. We also have the election. So in any election year, you usually have a little bit higher levels of volatility. This year, we've already had historic volatility in the first half of the year. And now, as we get closer to the election, we think that there probably will be some renewed volatility in the markets as well. The good thing is that in most of our portfolios, we have ample levels of cash. So we are in position to take advantage of any volatility we see and any opportunities that it may present. So what should investors do? Well, the one key principle that always serves investors well, throughout time has been to stay diversified. So we would say that means don't chase stocks, don't chase a lot of these overvalued stocks. Don't let your portfolios get too overweight into any one area. Rebalancing we think makes sense because a lot of these really good companies that have been out of favor and haven't been participating will likely come back at some point. So in the meantime, what we want to do is just stay diversified, manage our risk, and stay disciplined. And with that, I want to thank everybody for tuning in to our Q3 webcast. If you have any questions or comments, you can always email us, and I will turn it back to the operator.
Ladies and gentlemen, this does conclude today's session. We thank you all for taking a moment out of your day to share with us. And on behalf of CIO Jordan Kahn and as well as everyone at HCR, we thank you. You may now disconnect your lines. Have a great day. All right, Jordan, we're clear.
Okay, everything good?
I think it was. I think it went well on my end. Your audio was strong the entire time. All the slides moved perfectly.
Okay, good. Okay, great. Well, thank you for your help today.
I was glad to be on with you. Have a nice day.
All right. You too. Take care.